We've only got a half an hour, so we're going to jam through these slides. We want to get to the product. I see there's several people in here that have been in the mortgage industry for quite some time. Who remembers the pick-a-pay loan, the pay option arm? World Savings. So everybody has a smile. Some people are like, uh-oh, I better leave. I'm in the wrong place. So think of this product similar to that, but we believe we've fixed it, right? The problem with the pay option arm was we were loaning way too high loan to values. And the payment would recast after 110, 115%, causing tremendous payment shock for the customer. So we created a first and second lien home equity line of credit that has payment plans as low as 1%. So we're excited to share that with you. You can qualify more borrowers. It is on a HELOC, so it's not TRID or anything like that. So we're gonna walk through this and then make sure we have enough time for some questions at the end here. My name's Eric. I'm the EVP of Sales and the Chief Revenue Officer of High Tech Lending. Some of you might know us as American Senior Lending on the reverse mortgage side. So we also do reverse mortgages. I saw a couple shout outs to 49er fans there. So Kittle, and that's awesome. I'm from up north. So, and this is Rich.
Hey, good afternoon, everyone. I'm Rich Walker. I'm the Vice President of Wholesale at High Tech Lending. I've been doing this for 5 years in wholesale. I've also been an operations manager, so I'm very well versed in file structures and guidelines. And I've been at High Tech Lending for 15 years. I think it's a great company. We've got a lot of great products, and we've also become high tech again. We've adopted all sorts of new AI products, and it's good to be back as high tech, let me tell you. Instead of American Senior Lending was great, we're doing only reverse mortgages, but now we have a new product, so high tech is back in the wholesale.
So I want to be clear, this is not a reverse mortgage. This is available to anybody that's 18 and older. But it is age-based LTV. So the older you are, the more loan to value and the more cash, the proceeds the client might qualify for. So coming out of the gate swing, and just show you a real example of a client that with a maximum DTI of 50%, they went to a bank that everybody knows. It's a bank located in America. I can't say which bank. It's a very large bank, and they could only qualify for a payment to hit the DTI of $260 a month. They qualified for $33,000, which wasn't enough to cover the home improvements that they want. They came to us, they qualified for a $200,000 home equity line of credit with a qualifying payment and a capped payment of $260. So what that means is for the next 40 years, they're never going to have to pay more than $260 a month for that 40 years. So right here, do you struggle with borrowers that might be in a good equity position? Maybe they've got decent credit, and when I say decent credit, it's a 650 plus FICO, but you just can't pencil it out. Maybe they're self-employed, maybe they're on a fixed income, maybe their DTI is just not working and they're W-2'd. That's where Equity Select is going to shine. We have qualifying payments. Our qualifying payments is dramatically lower than a traditional HELOC or a principal and interest type payment. It works well, like I said, for fixed income self-employed borrowers, and it allows borrowers to access equity without blowing out their monthly cash flow. So let me walk through a quick scenario here for you. This is a second lien example, a $300,000. This client was looking for a $300,000 second lien option. Maximum DTI is 50%. So with their income situation of $7,500, they could only afford a $950 a month home equity line of credit. If they tried to qualify for a traditional home equity line of credit, their payment would be $2,250 a month. With Equity Select, we give the client payment plan options. So the interest rate, as you can see up here, the interest rate on this particular example is 8.75%, but the client qualifies for a 1%, 2%, and 3% payment plan. So they get to decide which payment plan they want. So imagine being able to go out to your market and market a product that's a $300,000 second lien home equity line of credit with a payment plan as low as $391 a month. That's what Equity Select does. Now, if they want more cash, the way this works is the higher the payment plan that they select, the more money that they're going to qualify for, the higher the loan to value that they'll qualify for. At the end, we're going to show you an intuitive calculator that we'll give you guys all access to that you can go in and start pricing out clients as well. You want to handle this?
Yeah, this is a first lien scenario. Client was denied for a $495,000 loan amount. I believe it was a non-QM scenario. The qualifying payment on that rate was $3,200. But you can see on a 2% payment option, the payment was only $1,135. So that took us, our DTIs were totally blown out of the water of 72%, and we brought it back down under 42%. So we found the best use case scenario for the first lien product is generally when you have a borrower looking for a cash out refi on a first, and their DTIs just aren't there, and we can boost their DTI abilities with the first lien product.
This is a second lien option, $150,000. Same scenario, the client chose a 5% payment plan. And in this scenario, there we go. He was at 55% on a traditional HELOC DTI. And with Equity Select on the 5% payment plan, he qualified for $150,000. And it got his debt to income down to 48%. So before we jump into the calculator and show you some examples and run through that, just a few highlights on underwriting guidelines. 650 FICO, debt can be paid off to qualify. There's no prepayment penalties on the loan. It's got an expanded DTI ratio. So Regulation B allows us to qualify homeowners that are 62 and older with expanded underwriting guidelines. So what we allow for homeowners that are 62 and older, we can dissipate assets, so stocks, bonds, mutual funds, IRAs, 401ks, checking savings, things like that. We can also dissipate post-close line of credit proceeds. So if they've got available line of credit after closing, we dissipate that, and the calculator does it for you. It'll dissipate those proceeds and count that as income to help them DTI qualify. It's got a protected line of credit balance, so if you close a loan and you've got a $100,000 available line of credit and they choose to make the minimum payment and it doesn't cover all the interest, so it adds it to the balance of the loan, that does not eat into the available $100,000 that they had at closing. So that continues to be available for the customer. No recasts, so that's a big one. Unlike traditional HELOCs, after 5, 10 years, the payment recasts into a 15 or a 20-year principal and interest payment. The minimum capped payment never recast for the duration of the loan. And accessing funds on the first lien option, they can access available line of credit for the first 7 years, and on the second lien for the first 5 years. This is our online decision engine. This is what we're going to give you access to. We've got a QR code at the end. You can request it. You guys are already approved with us. We'll send you a username and password. This has not only the calculator, it's an underwriting engine. It's going to calculate all your DTI. It's going to calculate the proceeds, the payment plans that the client qualifies for. But it's also our portal with a bunch of marketing materials so you can start marketing the product in your market as well. Couple quick things here. You can earn up to, so there's borrower paid and lender paid compensation on the loan. You can charge up to 2% origination fee on the max line of credit at closing. So they don't have to take the entire amount. You can charge up to 2% of the max line of credit. And then we pay up to 3 points on the back end for yield spread pricing, depending on the scenario and the margin that you select, which we're going to demonstrate for you now.
All right, we got a few different scenarios lined up for you. This first scenario is on our first lien product. This is for a borrower born in 1940 with $1 million home value, $200,000 payoff. And you can see easily here that the 5% has a much higher loan to value here. As you can see, the loan amount $682, and it waterfalls down to $643, $604, et cetera, as the payment plans go down. But you also notice how the payments dramatically change, whereas a borrower born in 1940 could get a $527,000 loan with a qualifying capped payment of $688 a month. This is a same aged borrower, but this is a second lien option. So you can see here they qualified for up to $400,000 on a second, all the way down to $315,000, depending on the payment plan. Sorry, my Teams just keeps blowing up over here. Let me try to turn that off.
It's all those equity select loans.
Right? We got to
So
answer those
the
questions.
capped qualifying payment, right? That's the starting payment on the 1%. Would you expand that real quick?
Yeah.
So scroll all the way to the bottom. Keep going all the way to the payment. So if you see here, you see the estimated initial monthly payment over here on the right for that line of credit is $212 a month. So it's 1% of the balance annualized every single month. So depending on what the balance is at the end of the month, take 1%, divide it by 12, that's your payment every single month until it hits that capped payment. So once it hits the 411, the capped qualifying payment, the minimum payment stops, and they'll just be required to pay that minimum payment for the duration of the loan. So that payment's never going to go above that capped quality. That's why we're able to qualify them at that capped payment.
The initial monthly, that's based on they didn't take the full draw, is that?
Yeah, so in this example, see the starting loan balance there? $252,000, right? The starting loan balance. So 1% of that should be, check my math, should be $212 a month. That should be your first payment. So if they just make the minimum payment, the balance will increase by the interest that they didn't cover, and then the next month it'll recalculate that 1% payment till it hits that cap. Because the balance increased, so it'll go up slightly. That's right. That's right. Now they can always pay more, they just can't pay less. So think of this like a credit card, right? A credit card, you get your statement in the mail every single month, and you've got that minimum payment. We all know when you've got that minimum payment, if we just make that payment, there's a chance our balance is going to increase because the interest on that sucker is like 25%, right? But we know we should always pay more. But it's nice to know in difficult months, if you have that minimum payment, it's nice to know you can make that minimum payment.
So, in essence, the spread is the deferred interest of somebody passing. And when do they have to sit back and make
At the end of the term. So that's right.
the term is they have to make it?
Yep. That's right. So here's a feature we did add. That's a good question. So the question was, when do they have to pay back all the deferred interest, right, or the negatively amortized interest? There's no recast, so it can neg-am for the entire 40 years. But we put at the end of it, right, the loan comes due at the end of those 40 years. It's non-recourse. So us as a lender, right, we can't go after the heirs or the estate for any negative equity, or the borrower for any negative equity beyond what the property sells for. Yep, so the properties are only, yeah, exactly. You got it, you got it. So we added those features, and that's why, hey, we like this payment structure for a client that needs some cash flow today, and they're having a hard time qualifying for a traditional HELOC, or they just want the comfort of knowing they've got that low minimum monthly payment. So we go up, depending on the age, right? So it's based on age. So he's going to show you a couple scenarios. Is this the 80-year-old?
This is the 80-year-old.
Okay, so go back to the first. So on this one, hold on, that one is 682. So that one's 68% is the max on that. At
What's the maximum loan amount?
$4 million. We'll go up to $4 million. Yeah. On the first lien. On the second lien, we'll go up to $1 million. Yeah. Good question.
Yeah, so that's an 85. This is a 65-year-old. You see the LTVs come down with a younger borrower. And this product is available for all ages on the 5% payment. So this is a 45-year-old, where you can see they still qualify for the 5% payment.
So on the second, there's a CLTV.
That's right.
Go over that already.
Yeah, so it's based on age, right? So it's not just, 30 to 75. So we'll go up to 70% CLTV, but that's going to be a much older borrower. Yeah.
But we do have CLTV and LTV caps on the second. So you could hit the LTV cap if the borrower has a really strong equity position, before you hit the CLTV cap. And it could be vice versa. You could hit the CLTV cap before you hit the LTV cap because they don't have as much equity.
Good question. You want to go back to the...
Back to the slides,
Yep.
yes.
Yeah. So that actually, go back to the calculator real quick. We made it really intuitive. If you scroll up to the top, the very top, these are all the fields that you need to input, and we'll walk you through when we give you, we have video trainings to walk you through how to manipulate this, how to look at the different margins, because we have margins from 4.99 to 5.99% that the borrower, that you can suggest to the borrower. But everything's in here. On the first lien option, we have the estimated third-party closing costs based on the state that the home is in as well. So it's really dynamic, and it'll calculate all the dissipation of the income, dissipation of the LOC proceeds, and all of your DTI calculate. All you got to do is plug in the info. It'll give you the results. All right, here's another use case. We have a couple loan officers, and we just rolled this product out. We piloted it last July, and then we just rolled out the second lien option in December. So this is very, very new. We're rolling it out throughout all the states as we speak. And this is a use case that we've seen that we thought was pretty interesting. Somebody that had a $1.5 million home. They were wanting to buy a second property. They had a free and clear property. They just didn't want a huge mortgage payment on that $500,000 property. So they took an equity select out. It was $1,500 a month on the $500,000 condo that they purchased. And it was a way for them to access funds where they didn't have to worry about their monthly cash flow. This is just showing you, let me go back. In the marketing portal, like I said, we've got a ton of material that you can sift through. It's all white labeled. You can put your contact information, your logos on it, and start using that today. This thing is slow. All right, there we go. Here's some other business opportunities LOs are already starting to use right now. I'm going to start over here on the far right. Banks and credit unions. We just did a huge data load of the largest HELOC provider in the country. They gave us all their DTI turndowns, and over 20% of their DTI turndowns would have qualified for what the customer requested with that HELOC provider. So if you have bank relationships, really great opportunity for you to go and meet with them, show them the product. Hey, if you have any DTI turndowns, give me a call. Let me run it through my scenario, see if I can do something for them. Financial professionals, they love this product. We come from the American Senior. I know some of you said American Senior side, the reverse mortgage side. Sometimes financial planners have a hard time recommending reverse mortgages because if the clients have a perception that's negative on that product, then they're not going to look very good. So this product opens the door for the financial planner to say, hey, call Eric. Eric's got a unique tool that might, if we incorporate it into your financial plan, might give us a better outcome. So great opportunity for you to go speak with financial planners. Debt consolidation and home remodeling are the top two reasons why people get a home equity line of credit. That shouldn't be a surprise to anybody. And then fund to business. A lot of self-employed borrowers like this because of the payment flexibility. It really gives you that maximum payment flexibility. This is our QR code, so feel free to hopefully it works. Go there, fill out the form. You guys are already signed up. Plug in your information. We'll send you a username and password right away. We'll open it up for questions.
Did you mention there was a minimum that they have to take out at the beginning?
Good question. So they have to take out, the minimum loan amount is $75,000 or 50% of the max line of credit. So they have to take out one or the two. Yeah. So this is intended to be a primary residence loan. At the end of the year, we are looking at coming out with our investor an investment loan with the same payment structure, which is pretty exciting. So to answer your question, unlike an FHA HECM, right, where there's strict guidelines that the lender has to meet to get somebody out of the house, these are all Fannie Mae guidelines. So the answer is we will want our money back as soon as we find out they're no longer in the property. We're going to start saying, but if they're making that minimum payment and the estate's making that payment, we'll work with them. But it's not as stringent as like a HECM.
So a year, 2 years, 5 years down the road, that's
If we find out, we'll contact the homeowner, and within a few months, if they haven't done anything to look like they're paying back the loan, we'll start down the foreclosure process. If they're not looking to pay off the loan. So if we find out that they're not in there. That's right.
you got something in the loan documents that's
Yeah. It's well, we may market it. We just put in there that it's a primary residence. And if it's not no longer your primary residence, we want our money back. That's right.
Question, are there any tools that kind of break this down, like graphical formats, similar to the Illustrator in the reverse world?
In what regard?
Sort of
The amortization?
yeah, the amortization.
You want to show them real quick?
Yeah.
We only have a half an hour, so we're trying to. This is normally an hour presentation, so let us show you real quick. If you scroll to the bottom, all the way to the bottom. There you go. So click on. Go ahead and click on that one. View amortization, and then this gives you the ability to select the home price appreciation. If the client wants to make additional payments, they don't want to just make the minimum payment. You can do that. Click on. There you go. And then that'll show you year over year what the loan balance does, the property value, and remaining equity. So that's built into the calculator. Good question. Thanks for bringing that up. 50% of the max line of credit.
Yeah, so the minimum loan amount would be about $84,000 because you're capped at 90% of the line at your initial draw. So if a $75,000 is your initial draw, you need an $84,000 line to get that initial draw of $75,000.
Good question.
Could you go over the comp again on the back end, you said?
Yep. So back end will pay, and it's built in here if you scroll up. If you can see here, this scenario pays 103 pricing on the the starting loan balance.
Yeah, this
so
is
you
a
make
first lien.
3 points on the back, and then on the front, if you scroll up,
Oh, whoops, I was going to show the,
just scroll up.
on the front, don't I have to show
Nope,
expand
just scroll
results?
up. Just scroll up. Right
Oh,
there.
there you go.
can charge up to 2% of the max line of credit on for origination fee.
And is the back end off of the draw or off of
It's the initial draw.
the initial draw?
You got it. You got it. Yep.
Commission caps on that, 5% or 3%?
It's still section 32, right? So we do have to kind of make sure that we're still within that, but that's off the max line, the starting loan balance, not the max line of credit. So the max commission, it goes up to 3% on the back end and then 2 origination on the max line of credit on the front.
You did a $4 million first,
Yeah.
and the
No dollar amount. Yeah, no dollar amount. Yeah, 5. Okay. Any more questions? Yeah.
So what does the select margin do? You said you can,
Yeah, so you can change the margin. So here's how the margins work. There's a 499 to a 599 option. So if you go to the 499, if you notice your price changed, right, because it's a smaller margin, go to 499, that's at par. So that would be you're charging 2 points on max line of credit, and then there's nothing on the back end in that scenario. But it would be a lower rate for the client.
You could also see it lowers the LTV a little bit between, 599 offers the highest LTVs.
So if the client wants max proceeds, pick the highest margin.
If the max they can get out at closing is 9% line of credit, when can they access the remaining 10%?
Good question. So as soon as that loan funds and boards with the servicer, they can take it out. Yeah. So we had one, it was a week and a half, they took out the remaining 10%. And then we are coming out with a purchase option in March. So right now it's just available as a refinance or a standalone HELOC. You'll be able, on the second lien, you'll be able to use it as a purchase lien first in March.
Is there a prepayment?
What's that?
Is there a prepayment?
No prepay. No prepay.
EPO is 12 months though, so if it's something that they're going to use as a bridge loan, probably give them that lowest margin, so that way there's no yield spread premium. You don't have to worry about premium recapture. You just charge money on the front.
There's no EPO on the origination charge?
Nope,
No.
that's borrower paid.
That's a good point. Yeah. So if you just charge a ridge, no yield spread, there's no EPO on that.
Okay.
Yep. Any other questions? You want to go to that slide real quick? So if you haven't done so already, make sure you log in, fill out that form. We'll get you that username and password right away, And we'll be here for the next 2 days. If you guys have any questions, we'd love to talk to you. Oh, one more.
Quick question on the qualification. What do you guys use for the qualification?
So pretty standard, right, depending on their situation. But remember, if they're 62 and older, we can qualify based on assets alone and post-close line of credit proceeds.
That's on the first lien.
On a first lien. We just had a 90-year-old that was making, no joke, $300 a month on Social Security. That's all she had. She couldn't get a loan anywhere, and she qualified for Equity Select. She qualified actually for $900,000. It's bizarre. So, because of the asset dissipation. That's right, yeah.